Yo, what's up guys? It's your boy Looney. Today I want to break down what I think is one of the best passive income strategies you can run in 2025, and that is selling cash secured puts. This is something I do week in and week out, and it's a strategy that doesn't get enough attention because it's not flashy, but it works. So let's get into it. But before we do, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month. That gives you access to one-on-one coaching, trade callouts, my full option selling course, giveaways, and more. The links to that are in the description. Now, let's actually talk about selling puts. And I have a cash secured put on Mara, so we'll look at this one. And I also have one on Oscar as well. But how does it work? So essentially, you pick a stock that you'd love to own at a discount, and you sell a put option. When you go to trade options, we're going to choose a random expiration about a month out. Expiration isn't that important when it comes to selling options. It kind of comes down to your personal preference, whether you want to do more management or less. That depends how long you want to go. If you want to go longer out, there's a lot less management. But if you want to do weekly options, there's a little bit more management with it. But all in all, it doesn't really matter too much. But when you choose your strike price, you want to make sure you're choosing below the current stock price. And for doing that, you get a premium. You get that premium up front because you are putting up this cash, basically saying that you agree to buying the stock at the strike price for whatever you choose. And to do that agreement, you get paid a premium. In this scenario, I would be getting paid $82, and I'd have to put up $1,700 in cash collateral, essentially saying I'm okay with owning Mara at 17, which I guess I am. Selling puts right now is a bit difficult because we are in a bull market and the prices are a little overextended. So I'd be doing this strategy very strategic and being very selective, because you don't want to be putting all your eggs in one basket, and then when the market finally turns around, you're in a tough situation. But if the stock stays above that strike price that you choose, the option expires worthless, which is good. You get to keep that premium as profit. So you do get this premium up front, but you don't realize that gain until it expires worthless. Because if I did this trade and went to go close it, I'd probably have to pay the same, and I would get no profit from it. But if the stock drops below the strike price, you get assigned. And assigned, all it means is you'll be forced to buy the shares. But that's fine because you're choosing at a discount compared to where the stock is right now. And you might be thinking, why not just wait for the stock to drop? And the issue with that is you don't know. You don't know if the stock is going to drop. And if you did know, you would be probably doing a buy put. But a buy put is a little bit more risky and a lot more speculative, and you got to do more guessing. Or maybe not guessing, but your direction needs to be right. With selling puts, direction doesn't matter too much. As long as the stock is sideways, slightly bullish, or really bullish, that is how you win. Now, the only way you lose this trade is if the stock drops below, and it drops really low. But at the same time, if you were to just buy and hold, you would also be in a tough situation. So that's why selling puts is a great strategy to incorporate to gaining a portfolio, getting a good wealth. And I'm doing it on Mara and Oscar. So let's pull up this Mara one. I was just going over it with an example, but I already have this one that I opened a bit ago when the stock was a lot cheaper. And you want to do this ideally on red days, and that's when the premium is a little bit more juicier. The prices are a lot cheaper, so selling a put on red days is the most ideal setup. Also, there's some other indicators like RSI, MACD, Bollinger Bands. You could look at those. Those aren't always perfect, so that might not be the best, but you really could just kind of wait for a red day or pullback to sell a put. So in this scenario, if Mara stays above 13.5, I get my realized profit of $43, which it seems like it is. It's already up $36 or 83%. I could close this and not realize a gain of that full 43, but I'll get pretty close to it. Now, let's say somehow Mara drops really low and it drops to $14 or 13.5, I will get assigned. And my cost basis will be 13.5. You could also factor in the premium. So it wouldn't be really 13.5. It would be whatever that break even price is. It would be 13.07. That would be my true cost basis because we're factoring that premium. And I've done it on Mara. So Mara, I own 212. 200 of those were through selling cash secured puts. And then you could also sell covered calls. And that's another strategy, very similar idea. This market is running hot, so a lot of my covered calls are in the red and I'm constantly having to roll it. But whether you win or lose, you're either making money or buying shares at a cheaper price. So that's with Oscar. That's with Mara. Let me show you one with Oscar, and that should be here. Oh, wait, no. I might have closed it. Let me see if I could find it. Yeah, I might have closed my Oscar cash secured put. Yeah, I already closed it, but recently I had a bunch of cash secured puts. This one, I made a profit of $40, and it was because Oscar was very unlikely of hitting that strike price. So I wanted to realize that gain quickly, and I sacrificed a few dollars. Now, let's say you want to choose a stock that's a little bit expensive and you don't have that cash collateral. You could actually sell a put credit spread. And I'm going to show HIMS because HIMS is a little bit more of an expensive stock. And if you bullish on it, you could still sell a put, but with defined risk. So again, let's go about a month out. We're going to want to choose a delta or a strike price. I like looking at delta for that. So I'll look at one that's like really low, probably this 48 one. And then you want to buy a put at a lower strike price. And it sets up a put credit spread. It requires less capital and it's very defined risk. So there's pros and cons to this. Yes, you can get a better return doing this. But on the other hand, is if you lose this trade, you lose the money. Where when you sell cash secured puts, all that happens is you get assigned and you have the shares. But in this scenario, if it goes against you, you don't acquire any shares, so you don't get that share appreciation. So I do mix this strategy in every now and then, and something like HIMS would be perfect because I don't want to put up $5,000 right now on HIMS and have the potential of it dropping below 50, and then I don't have enough cash to even buy more dips. So put credit spreads is a good alternative to selling straight up cash secured puts. And the strategy has been working. I mean, past year I'm at 51%. I know you're seeing people up 200% buying options. Yes, they do work, but they are risky. So when the market turns against you, I'm not sure if those will be the best strategies. Really, you have to be strategic with what you're choosing. I wouldn't go all in on just selling cash secured puts because that's not a flawless strategy, but it is very consistent. So you can stack these premiums week after week, month after month. Selling puts does consistently build a cash flow stream inside your brokerage. So again, it's not 100% passive, but yes, you do need to manage your positions. But compared to active trading, it's one of the easiest ways to generate real money because you're not betting on direction. So to sum it up, selling puts is a way to generate steady income. You're either paid to wait or you get stocks you want at a discount. You also manage risk by sticking to companies you'd actually own and by not over allocating. For me, this has been a core strategy in growing my portfolio. And I think in 2025, while everyone's chasing hype, this is one of the best strategies to quietly build wealth in the background. Until next time, peace.